Happy Easter, happy spring, maybe a spring break. Maybe you're just doing some spring cleaning. But how about a quick check-in? As the first quarter, it's done and dusted, and we're already charging into April. Yeah, another busy start to the year. Headlines about the war in the Middle East, continued debate over how AI, artificial intelligence, is going to change our jobs, our culture, our economy, our lives. All that made for a bit of turbulence so far this year in the market. The Dow finishing March down about 4% for the quarter, and the broader market, the Standard & Poor's 500, what everybody talks about as being the market, well, that was off almost 5% year to date. But hey, let's be honest, we've seen all this before. Every year brings its own crisis du jour. Right now it's AI and geopolitics. Just last year it was what I like to call the Trump tariff trauma of 25. And before that we had the 2020 corona crisis. Go back further, 2018, Trump tariffs 1.0. 2016, remember this one? I bet you don't. Brexit exit. Back in 2014, Russia invading Crimea. And on it goes. Each one felt like the big one, right? At least it felt like the big one at the time. But most of them have faded into history. I bet you can't even remember most of them, if not all of them. The markets hit bumps, sure. People felt nervous, and then sooner or later, things stabilized and moved forward again. That's been the pattern for decades. That's why our planning approach builds these surprises in from the start. We don't know what the next crisis will be or when it'll hit, but we don't care. We absolutely know it's going to happen, and we're prepared for it. Yeah, you've heard me speak about this before. Here are our core beliefs that guide everything we do. We don't do market timing. We don't forecast the economy because we're investors, not traders, and definitely not speculators. Because timing the market means trying to predict short-term movements, and that's just not how long-term wealth is built. Our job is to stay invested, stay diversified, and stay disciplined. If you're still in that phase of accumulating assets, meaning you're adding to your investments every month, short-term drops are actually a good thing. They're your friend. Lower prices mean you're buying more shares of great businesses at marked-down prices. And that's a blessing, not a curse. Remember the old buy low, sell high? Of course you do. And we always plan for bear markets. Roughly every 5 years, the market decides to remind us that it can be uncomfortable. But that's the payoff, the trade-off. It's always temporary. Always. Historically, recovery follows. It's sometimes fast. Coronavirus, remember that one? Sometimes slow, but always forward. So, here's my advice for spring. Enjoy it. Turn off the TV, get outside. Yeah, especially turn off the business channels and just cut your news intake overall. You'll sleep better. I did, and I do. So as we close the first quarter, here's my message. It's simple. Stay the course. The portfolios are doing just what they're designed to do, helping you manage risk, participate in growth, and keep your long-term goals front and center. Hey, if anything in your life has changed, maybe a big purchase, a new house, a shift in your health, or even how you feel about retirement, maybe the timing to retire, or maybe you're retired and maybe the time is to unretire and do something else. Yeah, maybe some new kind of a gig. Let's talk. Otherwise, you're right where you should be, positioned to weather whatever the world throws your way. Thanks again for being part of this journey and for letting me walk with you through each season of life. In the meantime, I'll see you in the next episode.